Okay, let's do a question called question Pink Scope, which is from March and June 2019 sample question. And this question is on real versus money analysis. Now, the reason I'm doing this question because in your notes, if you remember, I said that you have the exam tip. We must use money discount rate when we have more than one inflation rate given in the question. So when we have more than one inflation rate, we use money discount rate. And when we have only one inflation rate, we may use real analysis or money analysis, right? It's an option. This must does not mean that we don't have the option to do the same question using real analysis. We can do that, but of course it will be difficult, right? Now, what is happening in this particular question? The examiner has not given you this choice. The examiner has asked you to calculate the question using nominal analysis or money analysis. And then in the second part, the examiner has asked you to calculate the same question using real analysis, right? So we are going to do it in the difficult way, of course, if we don't have the choice, right? So let's read the requirement first of all, and then we'll solve it. It says calculate nominal net present value of Pinksco's investment project. And the second one says calculate real net present value of the investment project and comment on your finding, right? So we have to do the same question using two different approaches, and we should have the same answer. Now, my answer will be slightly different from the examiner answers on the basis of two things. First of all, examiner has actually just assumed that, well, one particular line, he has actually taken it to be the same for money and real analysis. And that's why the answers are not exactly the same, right? And there is another point also that I'll actually discuss during the questions. It says Pinksco is a large company listed in major stock exchange. In recent years, the board of Pinksco has been criticized for weak corporate governance, and two of the company's non-executive directors have just resigned. A recent story in the financial media has criticized the performance of Pinksco and claims that the company is failing to satisfy the objectives of the key stakeholders. Now, this information is actually relevant to part B, and I'm not doing part B right now. You can actually see in the examiner's answer. I'm more interested in part A. So it says in the second paragraph, Pinksco is appraising an investment project which it hopes will boost its performance. The project will cost 20 million, so it is the investment amount, 20 million, payable in full at the start of the first year of operation. The start of the first year basically means right now, or we can say this is year zero, right? Because end of the first year will be year one. Start of the first year is year zero. The project life is expected to be 4 years. So this is the life, 4 years. Forecast sales volume, selling price, variable costs, and fixed costs are as follows. So we have the sales volume, 300,000, 410,000, 525, and 220,000. We're given the selling price per unit. If you can see, the selling price per unit is not the same every year, right? Variable cost per unit is the same every year. Fixed cost is here and it's also changing. And then we are given sales price and the cost information are in current price terms, which basically means that all these figures are having no inflation, right? So in money analysis, we will have to inflate it up, right, with their respective specific inflation rates. Before applying the selling price inflation is 5%. So this is the selling price inflation. Variable cost inflation is 3.5% and 6% is the fixed cost inflation, right? Now, Pinksco pays corporation tax, which is 26%. The tax liability being settled in the year in which it arises. So there is no time delay in the payment of tax, right? Normally, in most of the questions, we have 1 year time delay. In this question, we don't have any time delay. The company claims capital allowances, well, it's tax allowable depreciation or capital allowances on full initial investment of 20 million. And it's 25% reducing balance basis. right? So tax rate is 26% and capital allowance rate is 25%. The investment project is expected to have zero residual value, right? So no scrap value. PINKSCO has nominal after-tax cost of capital of 12%, real after-tax cost of capital of 8%, and general rate of inflation is 3.7%. Now, this general rate of inflation is basically the one that we use in the Fisher formula. Now, in most of the questions, you're normally given two of them and you have to calculate the third one, but in this one, you're actually given all three of them, right? Now, if the money discount rate is 12% and the inflation rate is 3.7%, so the real discount rate should be this figure, which is 8.00385728.1%. Well, we are given 8%, so we are going to use this 8%. So why did I calculate this? So that we can actually get exactly the same answer for both part A and part B, right? So we are not going to use the rounded figure of 8%, and we are going to use this figure, right? It's not that you have to use this figure in examination. You see, this is not your examination. We want to get exactly the same answer, right? In examination, of course, you'll be using 8%. You don't have to calculate this figure because it's already given to you, right? Just to get the same answer. That's why we are doing it. Otherwise, you don't have to do it, right? So this is basically the question. Now we are going to do the question in Excel, okay? Okay, so things go at A, right? And the first requirement is net present value using money analysis or nominal analysis. Okay, now we know that we have 4 years. So I'll start from here. I'll say year 0, 1, 2, 3, 4. Okay, I want everything in the middle. Okay. Now, first of all, we'll calculate the contribution. Now, I sometimes prefer to do the calculation of the contribution within here, right? But just to make your answer look cleaner, right? Maybe you can do it separately. So contribution, this is your working one, contribution. So you have year 0, 1, 2, 3, 4, right? Now we are given the selling price per unit, which you can see in the question that it's not the same every year, it's different, right? It's 125, 130, 140, and 120, and it need to be inflated up also because we are doing money analysis, right? Now, the way I prefer to do it, I'll actually do it for this first cell, so selling price per unit. So I'll say it's 125 multiplied by 1.05, the inflation rate raised to the power 1. So what I normally do is I'll say is equal to 125 multiplied by 1.05 raised to the power 1. I'll apply it on all the cells, but then I have to do some adjustments, right? Can you see it's 125 for the first year and then 130, 140, 120 for year 2, 3, and 4. So this one will be changed to 130. I'll change this one to 140. And I'll change this one into 120, right? So anything that you can do to save some time in examination, right? You should be doing it. Now, variable cost is 71 for all the 4 years and its inflation rate is 3.5%. So variable cost per unit, I'll say is equal to 71 into 1.035. Let's double check it, 3.5%. So yes, 1.035 raised to the power 1, and we'll inflate it up year by year for all the 4 years. Selling price minus the variable cost will give you contribution per unit, which is this minus this. We have the contribution per unit. And now we are going to multiply the contribution per unit with the number of units. You know that the number of units are 300,000, 410,000, 525,000, and 220,000. So 300,000, 410,000, 525,000, and 220,000. Right? So now we can calculate the contribution, right? So the contribution is simply the contribution per unit multiplied by the number of units. So we have the contribution for all the units and we're going to apply it on all the cells. Okay. So now we have the contribution per unit, right? I'm going to copy it from here, Control C, and paste special in your examination. So you'll have all the figures now. Okay. So that's the contribution figure. Now the fixed cost, we can actually do it within the main answer. We don't have to do it separately in the working. The fixed cost is 300,000, 3,100,000, 3,200,000, and 3,000. Now in this one, you can see that 300,000 is the same for year 1 and year 4, but the middle one will need to be adjusted and inflation rate is 6%. So I'll say 300,000 is equal to 300,000. Sorry, it's not 300,000. It's 3 million. Sorry, yes, it's 3 million, right? It's in thousand, is 3 million. And 3 million will need to be inflated up by 6%, so 1.06 raised to the power 1. Now I'll inflate it up for all the years. Now you see, for year 1 and year 4, it was the same 3 million, but year 2 and year 3 need to be adjusted. That's 3.1 million and 3.2 million. I'll change that to 3.1 million and I'll change this one to 3.2 million. Okay, so we have the values for the fixed cost. Okay, now after the fixed cost, now we can easily calculate the cash flow before tax, which is contribution minus your fixed cost. We are calculating this so that we can calculate taxation after this, and you know that tax is 26%, right? So 26% means 0.26 multiplied by this figure. Remember, the tax is in the same year. There is no time delay in taxation, right? So we have the tax. Now, immediately after calculating the tax figure, we are going to calculate tax savings also on capital allowances. So tax savings, and we have to do it separately in the working. Now, depending on how do you want to calculate this, right? There are different approaches, right? I prefer to do it like this. I have the 3-column approach, the 3 rows approach. So I'll have, of course, first of all, year 0, 1, 2, 3, 4. And then the first row will be opening. The second row is capital allowance. The third row is tax savings. Now, I prefer to do it like this. I think you can save a lot of time in examination if you follow this. In opening, in the first one, you'll be writing your investment amount, which is 20 million, right? So 20 million is the investment amount. In the second row, you'll be writing the written down value. Now remember, the capital allowance is 25%, so the written down value will be 75%. The 75% of this value, of the previous cell value, will be 1500, 15 million, right? You'll apply it on the next three cells, but not in the fourth one. In the fourth one, which is the last year, you are going to write the scrap value here. Because in this particular question, the scrap value is nil, so we are going to write 0, right? Now, the second row, we will calculate the capital allowances, which will be this minus this. You see, if 15 million is 75%, so the remaining figure will be the 25% capital allowance. And then you apply it on all the cells. The third column will be the tax saving, because tax is saved in the same year. So I'll be calculating the tax saving in here by the tax rate, which is 26%. So 0.26 multiply by the capital allowance. We'll apply it on all the four cells. I'm going to copy it from here, and I'll write the tax saving working in here, case special. Okay, so we have the tax savings now. After the tax saving, the next working, whatever is remaining now, we are going to write. I think the only thing that is remaining is the investment amount. Investment amount is 20 million. Right? So 20 million is the investment amount, right? Now we have the investment amount. So I'm going to calculate the net figures, right? So I'll start from the cash flow before tax. Tax payment is outflow, so minus tax payment column. Tax savings in inflows, so plus the tax saving column. Investment is outflow, so minus the investment amount. So all the positive and the negatives will be sorted out, right? So we have this figure of the net figure, and then we simply have to use the 12% discount rate. So discount will be 12%, which is the nominal discount rate. So I'll say 1 plus 12% raised to the power minus 0. And then I'll apply it on the remaining cells also. So it's automatically going to pick up all these years, right? It's rounded. So we'll keep it to 3 decimal places, right? So we have the value up to 3 decimal places. And then we can calculate the present values. So the present value will be this figure multiplied by this figure. So we'll have all the present values, and then the net present value using the nominal term approach will be is equal to sum. You select all the cells and calculate it. Now there are different ways to calculate this. Of course, I prefer it to be calculated like this, right? If you know the net present value function, and if you want to calculate it directly, it's up to you. But I think that it is going to save you some time if you do it like this in examination. But it's up to you, perfectly up to you. Okay, so that's how we did it for the nominal term approach. These extra cells, I don't need it. I'm going to delete this, right, so that you can see everything clearly. So this is the answer for part A, which is the nominal term approach, NPV using the nominal term approach, part A1, right? And then part A2 is again net present value. using real analysis, right? Now, in the real analysis, what do we do? It's very tempting that you start thinking that, okay, well, I don't have to inflate up all the cash flow, so I'm just going to use these figures. Now, you cannot do this because there are different inflation rates and every cash flow has a different inflation rate. So what you are going to do, you are going to use all your inflated figures and then you have to deflate it using your general inflation rate, right? So I'm going to pick up the figures of the cash flow before tax from here. I'll paste it here, the cash flow before tax, paste special, okay? So I have the cash flow before tax here, and then I'm going to convert it into real cash flow before tax. So real cash flows before tax, which means I have to deflate all the figures, right? Which will be this figure multiplied by the general inflation rate, which is 3.7%. So this multiplied by 1.037, right, which means 1 plus 3.7% raised to the power minus year 1. And then we do it for year 2, year 3, year 4, and all of them. So these are basically the figures that we have deflated. Okay. So these are the real cash flows. After that, I'm going to calculate tax, which is 26% on these, which is 0.26 multiplied by this figure. So everything should not include inflation. So even the tax should not include any inflated figures, right? So we have the tax. Now the tax savings, which is in here that we calculated above, your examiner has actually copied this line also and has written like, I mean, copy paste, and that's why there is a little bit difference in the answer. So what I'll do is I'll actually take these figures and I'll deflate these figures as well, right? So tax savings, right? So I'll take this figure, I'll multiply it with the inflation rate 1.037 raised to the power minus 1. So I'm deflating all these figures. So we'll have the tax savings also in real terms. Okay. Now, once you have the tax savings, after that, I think the only cash flow that is remaining is the investment amount. I'm going to copy it here. The investment does not have any inflation because it's already in year 0. So we don't have to worry about it, right? And then we'll calculate the net figures. So net figures will be the real cash flows minus the taxation row plus the tax savings minus the investment. So all the outflows will have minus sign, and then we can apply it on all the cells. So we'll have all the values, the net figures, and then we'll calculate the present values. The present values, well, of course, we need the discount rate. Now, the discount rate is given to us, which is 8%, the real discount rate, but we won't take that real discount rate because we want to get exactly this answer, right? In examination, of course, you can take easily 8% and it should be fine. So I'll say 1 plus the money discount rate, 1 plus 12%, right? Divided by 1 plus the inflation rate, so 1.037, close the bracket, minus 1, which is going to give us this long figure, right? Now, as once again, we could have taken simply 8%, but we don't want to take 8%. We actually want to take this whole figure, right? So what I'll do is I'll say is equal to bracket 1 plus, I'll click this cell, I'll press F4, which means that I want this whole value in here, $A, $31. So in A31, whatever is the value, if you write it like this, $A, $31, you can do it manually also, or you can just click here and press F4. You'll close the bracket, right? And then raise to the power minus here 0, enter, and then apply it on all the cells. Of course, we want it up to 3 decimal places. Okay. Even if you don't do this, it is going to give you the right answer. And then the present value. So the present value will be this multiplied by this, and then you can apply it on all the cells, right? Now, if you compare the present values above and in this line, you're actually getting exactly the same answer in both the cells. It's exactly the same. Okay. So now we are going to calculate the net present value, which is equal to sum, select the range, close the bracket, and enter. So the answer is exactly the same like above. Now, once again, guys, there are two things that I have done which was not necessary for you for your examination. So I've just done it for your understanding, right? So I'll show you the answer of the examiner also, right? Just give me a minute. I'll show you the answer of the examiner first. Okay, this is the examiner's answer. So examiner has actually calculated this, and this is the final answer, 33347, right? Our answer is 333,37699, right? Because of the rounding difference, of course, there is some difference, right? And then in this answer, if you can see, once in part A, you have this final answer. In the second part, what the examiner has done it, examiner is actually using exactly the same tax allowable depreciation benefits, the tax savings, right? 1300, 975,731 and 2194. So 1300, 975,731 and 2194, right? Exactly the same figures are actually used in both the parts. And that's why in the comments below, the examiner then mentions that the real term appraisal gives almost the same positive NPV as nominal term appraisal. The difference is being due to the different discount rate being applied to the same tax allowable depreciation benefits of the tax saving, right? So if you don't want to do that, then you can actually remove inflation from your tax savings also. So I've done the tax saving above, and I've done tax savings in here, and I have deflated these figures as well. Okay. And the other thing is that examiner has used 8% exactly, which you should be doing in your examination also. And I've actually used slightly different, slightly more accurate discount rate, right? In order to get the same answer, but you don't have to do it. It was just for your understanding, right? So yes, that's things go. If you have any question, do let me know.